This week I want to introduce you to the idea of momentum. Well, maybe not introduce you, but sort of refine your thinking of momentum a bit. We're going to look at both positive momentum and negative momentum. And positive momentum is identifying stocks that have a lot of buying power, where they're going up, and negative momentum is buying or looking for stocks that have a lot of selling power and they're going down and down. And I'm going to show you how to find them. But before we do that, let's have a look at 4 stocks that I've selected that would have shown up. The technique I'm going to show you, these would have shown up multiple times and would have given you multiple signals that these were under momentum. The first one up here, this is Apple. And this is going back to July 2016. So we got a 2-year chart up here. And back in July of 2016, this was running about a $110, $120 stock. It's $227 now. Even just as recently as January, what do we got here? January, February, March. Just even as recently as April, this was a $180 stock. Now it's $227. But look at this nice rise all the way through. And it paid a dividend along the way, 57 to 63. We're at 63. There's 73. So you have dividend increases over a period of time. This one over here is Amazon. This one has really been a superstar. Even as early as last year, last July, we were sitting at around $1,100. It's 2016. Down here we have Garmin. Garmin makes GPS devices, and Garmin used to be a high flyer, but then after the financial crisis they fell apart. They never really got it back. They had a little resurgence for a while, then they fell off, but lately it looks like they've been coming together quite nicely, and you can see them coming off from the lows way down here in July 2016, which is under $42. To over $68. And look at this, you got paid along the way, 51 cents, and they just recently raised the dividend to 53. This one over here is Arbor Realty. This is one I own, and I've owned for quite a while. I didn't buy it for momentum. I bought it for income because it's a great dividend stock and it has a history of increasing its dividend quite often. But lately it's been under momentum, which I'm more than happy with, quite happy. But look at the dividend history here. You had 15 cents, then it went to 16, 17, 18, then you got 19, 21, 25. So you have acceleration in the dividend. And even when it went from, if you look over here, 17, 18, all the way to 21, it didn't really lift the stock that much. So it seemed to be spring-loaded, that when you went from 21 to 25, that's what finally did it. So the next dividend is 25, and they've already announced a special dividend of 10 cents. So at the end of the next quarter, there's a 35-cent dividend waiting there. And the expectation is that they're probably going to raise their dividend again. So this one is currently under momentum. I've held it before the momentum hit. I just want to show you what momentum looks like. So the question then becomes, yeah, we're all aware of these stocks, maybe not Garmin and ABR, but Apple and Amazon we're aware of. But how do you know, other than the popular ones like that, you know, the 4 or 5 big names that everybody knows, how would you find this guy, ABR? I mean, this doesn't make the news. Nobody ever hears about it unless you're in this particular space, in this particular sub-industry, in the sector. You would never know about this. Garmin, yeah, we've heard of before, but it seems like a story from a decade ago. How would you know? How would you know where to look for these things? And I'm going to show you a strategy that I used when I first started trading, and I had to come up with trade ideas. And the training that you've always had, and the training we have here in all levels of CFA, is we look for undervalued stocks and we want to buy those, and we sell overvalued stocks. Well, with momentum, that doesn't work. And in fact, with momentum, if you try to sell overvalued stocks, you will get killed. By all measures, Amazon is wildly overpriced. I think it's trading at about 160 times earnings. It is wildly overpriced. It has no reason to be there. Same with Netflix. It's trading at 150, 160 times earnings. Those are unsustainable PEs. But that doesn't mean that the price has to come down for the PE to get into a better place. Earnings could simply just accelerate and the price can go sideways, or momentum can just kill you. You never, ever, ever short momentum. So the valuation of these, yeah, they're ridiculous. So the traditional finance that we learn in level 1, level 2 for valuation says that these would be considered overvalued stocks and they would be sell candidates. For momentum, we have to change that thinking. We're not going to buy low and sell high. We're going to buy high and sell low. When I say buy high, we're going to find stocks that are breaking out and hitting new highs, and we're going to buy those, and we're going to find stocks that are breaking down and hitting new lows, and we're going to sell those. Then I'm going to show you a way to create a market neutral portfolio out of a combination of those stocks, so that if the market turns against you, at least you're going to hedge out the negative moves. And I think that you can make money on both legs because you're playing two sides of momentum. So let's have a look at how we find these. I'm going to show you a website. This is called barchart.com. And what we're looking at here are the 52-week lows. And you can find the 52-week highs just by clicking here. And it's just a list of all the 52-week lows and the 52-week highs. I like this list for a couple of reasons. I can identify the winners very, very quickly. So what I've got up here is all U.S. exchanges. I've got 52-week highs is what I'm looking for. So the first one on the list is Apple. Tells me it's at a 52-week high. That as of, the date is over here, as of August 31st, this closing price, 227.63, is a new 52-week high. This is what I really like. In the last year, it hit a 52-week high 42 times. So in other words, Apple told you, before today, Apple told you 41 times that it was hitting 52-week highs. Imagine somebody telling you that 41 times in a year. Oh, by the way, I just made more money. Oh, by the way, after a while, you'd say, okay, I believe you. So it said it 41 times before today. The next one, Arbor, 43 times in the last year. 43 times it hit a new 52-week high. And it tells you what the 52-week high percentage is above the low. So this is the percentage different from the current price of the 52-week low, 52.1%, 55%, 22.4%. So it tells you how far off the lows it is. The next one, Ares Commercial Real Estate, 24 times. Automatic Data Processors, 54 times. And there's a whole list. And you can go down the list. These are the 52-week highs. Now, they're not all going to be candidates. This, I'm not suggesting that this list tells you what to buy. This is a list that will identify candidates that are very interesting. And you would just sort of scroll down the list and you might have a rule. You might say, well, you know, I'm looking for stocks priced between, I don't want anything under $10, maybe somewhere between $12.50 and $45. Maybe that's your comfort zone. So as you're scrolling down, you'd say, yeah, okay, Apple, but you know what, $227, I can't diversify enough at that price. I can't buy enough of it and I can't diversify. You might look at Arbor, say $12.26, that's on my list. Ares Commercial Real Estate, that's on my list. You might eliminate the next three, they're high flyers. This one here is under $12.50. You might say, not interested in anything that low. Too high, there we go. There's one that hits your list. There's another one that hits your list. That's under $5. I would just avoid anything under $5 because it has no institutional support. And you just go down the list and you identify the ones that you're interested in. And it'll tell you over here how many times it's hit a 52-week high. And all you have to do, if you're interested in looking at some of these, is just to call it up on a chart and see what it looks like. If you want to identify, actually, do you want to look at a few of these while we're at it? Let's find something that maybe we're interested in. Let's just look at Acre, A-C-R-E. And I'll bring my screen over. 1 second. All right, so we'll just key this in, A-C-R-E. Hit enter. There's our stock. Let's get a chart up and let's see what we're looking at here. And this is from July 2012. That's maximum. Let's just look at a 1 year. And there we are. So I'd want to know what happened here. This looks quite significant. And then we had some consolidation pattern. Now it looks like we have another breakout. So this looks rather interesting. I'd want to know what's going on here. Their dividend was 27, 27, then 28. So they raised their dividend 2 quarters ago. They have a 28-cent dividend now. So that's $1.12 a year on a $14.62 stock. So that's a nice income-producing stock. So right away I would look at that and say, you know what? Even if it consolidated here for a while and didn't continue on, if I'm an income investor, I don't mind holding on to that. I'd want to look at what they do. I'd want to look at what their dividend payout ratio is. I want to feel comfortable about it first. The important thing is I have identified a candidate that I want to do a little bit more research on. I'm not just going to go ahead and buy this. That would be, well, irresponsible just to look at a chart. Oh, it's on a 52-week list. It's been there a couple of times. I'm going to go ahead and buy it. No, I want to investigate it. I want to know what risk profile I'm taking on, what its economic drivers are, what its economic threats are. What is the thing that could derail this story? I want to be aware of these things. How solid is that dividend? Is that a 70% dividend payout ratio? If it is, I feel good. Is it 110%? I don't feel so good. So I want to do a little bit more research. And that's, of course, what you do. The big problem is identification. Is how do I identify 20 or 30 stocks that I could put on my watch list that are worthy of further investigation? Well, here we go. This is a nice one to throw on the watch list. It's got a nice dividend yield to it. So I'm getting paid to wait. I'm getting paid $1.12 a year per share to wait. I don't mind that. It has increased its dividend, so it's got some history of increasing its dividend. If I want a better look at this, I can go out further. Let's go out to the maximum. Let's see what we have. And our dividend back here was 6 cents. Here we're at 25 cents, 27 cents, 28 cents. So we've really increased the dividend since 2013 to 2018 quite significantly. It had some altitude back here around the $17, $18 mark, but this is the maximum. So this probably was its IPO. There's always some volatility in the IPO until it finds a home, and it looked like it didn't find a very happy home for a while. This looks like a nice capitulation right there, and then a base is starting to build off of that. There looks like a line of resistance, if we want to be technical, a line of resistance across here for a number of looks like 4 years, 5 years of resistance, and now we have a breakout. So technically, this looks quite good. From a dividend growth perspective, this looks quite good. From a yield perspective, this looks quite good. So something like this, I would say, well, let me throw that on my watch list. Let me look into that a little bit more. What do they do? What are the economic drivers of the business? How do they make money? And of course, you know how to do all of that. We've done all of that at level 2. If you're only at level 1, well, you have that to look forward to. At level 2, lots of valuation. But what do you value? You need candidates. So here's one that seems rather straightforward. Let's go back to our chart. Let's have a look at the lows. Now these are losers. These are ones that are losing. So well, we can look down. This is 52-week low. There's a whole bunch of, by the way, if you're looking down, there's a whole bunch of resource companies and energy companies that are hitting 52-week lows. That tells you something about the sector as a whole. When you start seeing a whole bunch of companies from particular industries showing up on the 52-week low list, I know what sectors are out of favor right now. Looks like energy and basic materials might be out of favor right now. So that's something interesting to keep in mind. And there's a whole bunch of different companies on here. There's Newmont Mining. There's another resource company. And I've been through this. There's Paramount Gold and Silver. There's a lot of resource companies on here. I don't know that I would want to short a resource company. I think that I'd be more apt, if I were negative on resources, I'd be more apt to play the futures contracts on the commodities than to play the companies themselves. Because when times are tough, companies consolidate, companies merge, companies get acquired, and you get caught on the wrong side of an acquisition. Ouch. So I don't know that I'd be too eager to play in those particular fields. But there's a bunch that you could look at down here. Why don't we look at one just for fun? And for these ones, if I'm looking for a short candidate, I don't want the price to be too low. I want some altitude so that I can see. So the first one, we have one up here, AMBA, Umbrella Inc. I have no idea what they do. 52-week lows. They've hit the 52-week low 10 times in the last year. They're down 42% off the 52-week high. So as far as the stock is concerned, you're off 20% off the high. The stock is officially in bear market territory. So this is in bear market territory. Let's just get their chart up. I do have their chart already. And let's have a look at their chart. So this is going back out 5 years. So we can see that there was some initial excitement on the run up, and that excitement faded very quickly. This is called a dead cat bounce. When something falls, there's a little bit of a bounce before it comes right back down. It looks like we have a line of support, which used to be some kind of resistance back here, a line of support across this, and we've hit a 52-week low into the close on this date. So it does look like there's some downside movement. If we go back 5 years, this was a stock under $10. It's $38.49 now. I don't know, maybe this was a big long 5-year cyclical story. It did look like there was something interesting going on here. I'd want to investigate what this was. Maybe this was just a really good story that everybody bought into. And like good stories, if the fundamentals don't show up, that fades away very, very quickly. Maybe this was rumors of an acquisition. Maybe there was an acquisition that went away very quickly. I don't know. I don't know what this company does. I've just identified something that I'd say, you know what? Let me look a little bit further. I look along the bottom, and with Interactive Brokers, it'll tell me I see no dividend. So I'm good. If I had to short something, I don't want to see a dividend because I have to manufacture the dividend if it pays a dividend because I'm short selling it. It has no dividend. I feel quite comfortable about that. And it's sitting at the bottom of what looks like a double bottom right now. And it's got a downward sloping channel on the high. So every time it makes a high, it tends to make a lower high. The candles, if you're into candle charts at all, when you see these big wicks, see way up here where the candle ends and you have these long wicks, when you see just a whole bunch of these long wicks, that means there's a lot, every time it tries to reach up, there's a lot of selling power. Look at these big long wicks over here. You have these three little, I think they're called hanging something or other. You got 3 of them in a row, and that's usually 1 or 2 is a good enough signal for a large size drop on a candle. But you got these big wicks up here before it drops down. Now, for some of you out there who have listened to me in videos before, you're probably saying, I thought you hated technical analysis. I do. But I come by my hatred for technical analysis, or at least my lack of respect for it, honestly, because I have researched it, I have looked into it. So if you find that I know a lot about the technical signals, it's because I have looked into it. I have spent the time and I find nothing there. But what I do find is this. I find signals that everyone who follows technical analysis would believe. So here's the thing. I got them on my side. So if I'm looking at a chart, I want to make sure that there's nothing from a technical perspective that would threaten the story that this has downward momentum. And the technicals right here are telling me that, yeah, it has downward momentum. So technically it has downward momentum. So I don't have to worry about the crazies coming in saying, oh, did you see the triple this of the Fibonacci that doing this other thing with the Bollinger thing? I don't have to worry about some crazies coming in doing that. Let's have a look at that list again. And let's see what else we can do with it. Here's what I find can be kind of fun. Let's go back to the high list. Now these are 52-week highs that we're looking at. We can get a little bit more clever. We can say, look, let me just go back 1 month. Tell me what stocks hit a 52-week high just in the last month. Our first entry here, well, because it's in alphabetical order, but Apple, 14 times in the last month. So even if you just followed the last month, the 14th time was the close on August 31st. But before Friday, before last Friday, it told you 13 times, I'm making money, I'm making money, I make it 13 times. So there is some solid momentum. And you have a whole bunch. There's Arbor down here, 11 times in the last month. It hit a 52-week high. And I was well aware of that while it was doing that, and it was a beautiful month. I just kept saying, this is great, just keep going. And you just scroll down the list and you find maybe there's certain sectors you don't like this one here, this pharma. I would never, no matter what, 7 times in the last month it's hit a 52-week high. It's 34.58. It seems like the right price range, but I know very little about biotech and pharma. I don't know enough to judge the potential of those companies, and I have a rule: if I don't understand it, just ignore it, because there's plenty of stuff I do understand, and there's plenty of opportunities in the spaces I do understand. Why look for stuff I don't understand when there's a huge garden out there of stuff that I do? So some of these things I would just say, you know what, I'm not interested in looking up what they are. And a lot of these I don't know what they do. There's a lot that I don't know what they do, but that's the point. Is now I have a list of candidates, and then I can eliminate some candidates. So this is the 52-week. This is the new highs, 52-week high. So things like this down here, 33 cents. I would never be interested in something like that. 365, I would never be interested in. 291, forget it. Here's another one, 206. Anything under $5 has no institutional support. I would not be interested in. And they take a long time to move. So they may hit 52-week highs, but a penny at a time or 2 pennies at a time. That's nothing I'd be interested in. But you pick and choose what you would like to do. And this is actually a kind of a fun site to get to. So if you go to barchart.com and you go to the 52-week high and low list, you can play around. You have all the U.S. exchanges. You can take whatever exchange you want. You can say, well, I just want large cap, mid cap, small cap, micro cap, stuff under $10, stuff over $10. You can say by volume. I would never take anything under 100,000. You can't build a big enough position with 100,000, a stock that trades only 100,000 shares a day. So you can select your volume. You can say New York Stock Exchange, Amex, NASDAQ, ETFs, the over-the-counter. I wouldn't touch that. And on main view, here's what you can do. You can look at it from a technical perspective, from performance perspective, fundamental perspective. So if you want to have a quick look at some of the fundamentals, let's do that. It's not quite exact. For instance, here's Arbor. Saying that it's got a dividend, the trailing 12-month dividend of 90 cents. I think it's more like 92 cents. So it's off by a little bit. Not much, but it's off. But look at that beta. That's a nice beta to have. That thing is basically a bond. This stock just acts like a bond. Really low volatility. Nice high income, and it's under momentum. So the Sharpe ratio on a portfolio loaded up with that has got to be just absolutely beautiful. This is the kind of thing you want to find, where at the end of the year your Sharpe ratio is so absolutely unbelievable. It's like finding a bond in a rising stock market that's under momentum. It's incredible. But it tells you what the betas are. There's Apple at 1.16. The next one here is 1.37. This one here, it's Biomed. This is very typical of of these kind of stocks in that particular sector, is they tend to be unrelated to the market. They have betas very close to zero. A lot of biotech stocks just are not affected by market movements. They have very low market risk component, very high idiosyncratic risk. So this one here is really high in idiosyncratic risk. You're basically buying this all out. You're not being exposed to any market movements there. So it's not a matter of it's a positive market, I should be okay because it has a certain beta. You're buying this, you're buying that. That's it. So you really have to know what you're doing in these biochem, pharmaceutical stocks, and I know nothing about that. That's where all the med students and the doctors can play. All right, let's finish up with a list of rules here that you should pay attention to if you're going to play in this field. Number 1, never short positive momentum, regardless of valuation. Never do it. Tesla, Netflix, Amazon, yeah, absolutely ridiculous valuations. Never, ever, ever short momentum. Because if you did, what did Amazon tell you? Amazon told you that it made 52-week highs in the last year. So there were 52 days where you said, oh, come on, another high? Yeah, that's exactly what happened. You'll get crushed. There are better short candidates. And where are your short candidates? The 52-week low list. Those you can short. Number 2, 52-week highs on down days are very strong. So if the market has a down day, let's say the Dow is down 150 points or the S&Ps are down 15, 20 points, there's red across the board, go to the 52-week high list. If a stock is still hitting a 52-week high on a down day, there's something interesting there. There's something really good I want to find out about that. And it's the same with the lows. If a stock is hitting 52-week lows on up days, then that's a very strong short. Because if the market is up, again, let's say the S&Ps are up 15, 20, 25, 30 points in the day, and you have a collection of 15 or 20 stocks that are still hitting 52-week lows, even the market couldn't lift them. I want to know what's going on there. I want to know what's wrong with those particular stocks because those sound like fantastic short candidates. If you want to reduce risk, you can do a pairs trade. And a pairs trade is the beta of the high portfolio equaling the beta of the low portfolio. So what you might do is you might identify 5 candidates for positive momentum. And you might say, I'm very comfortable with these 5, and you'd create a portfolio, and that portfolio would have a beta. You'd want to construct your short portfolio such that it has the same beta, so that you're beta neutral, you're market neutral. Now, the nice thing about having a market neutral portfolio like this, and especially if you can find stocks that do what number 2 does. In other words, you're building a portfolio of stocks that hit 52-week highs on down days, and you're shorting a portfolio of stocks that hit 52-week lows on up days. Such that when the market goes up, your long portfolio will go up and your short portfolio will still go down. So your short positions will make money and your long positions will make money at the same time. So that's a sort of a nice place to be. The reason I say it reduces risk is because if you have a down day, it's more than likely that your momentum stocks will have a down day as well. But your weak stocks should really have a down day. It would be odd to see your weak stocks or stocks hitting 52-week lows suddenly turn around and start to run while the market is still selling off. So that reduces risk. A little bit more complicated to put in play, but as you get more comfortable with your trading, you may be able to do it. An easy way to do it on a 1-to-1 is to do it on a dollar value. So let's say that you have a long position and the beta is 1.1 and you have a short position and it is 0.9. What you want to do is you want to find dollar values of the two that are equal. So $100 multiplied by your beta equals whatever you need multiplied by 0.9, or $100 times your beta divided by 0.9 will tell you how big a short position you need. But as long as you can equate the betas, don't equate the dollar values. Equate the betas. And the reason I say don't equate the dollar values is because your long position has a beta of 1.1. If your short position has a beta of 0.9, the market drops 2%. The beta of 1.1 will drop by more. So you want to match the betas, not the dollar values. And number 4 is a very powerful one. Bit of advice: choose your momentum candidates wisely. Momentum is your friend until the end, and when momentum breaks, it breaks. You don't really have much of a chance to get out, and if you fall victim to things like loss aversion, those at level 3 will know exactly what that is. Loss aversion is the unwillingness to take losses. You can't suffer from loss aversion if you're going to trade momentum. You have to get out the moment you feel it's over. When is it over? I don't know. Nobody knows. Welcome to the game. But what you can do to choose wisely is find, if you're looking at the 52-week high list, find the ones that are hitting 52-week high because of accelerating growth. Accelerating revenue growth, accelerating earnings growth, find those. So that if you look back over 8 quarters, maybe they had 6% revenue growth, the next quarter was 8% revenue growth, then they had 10% revenue growth, then 12% revenue growth. So if you plot out their revenue growth, it looks like this. And this is the growth rate. And obviously each quarter is positive, but you have accelerating growth in either revenues, in earnings. If it's a young company, accelerating revenues are fine, even if the company's earnings are not accelerating, as long as top line revenue is accelerating. A mid cap or large cap, if you have accelerating earnings, I would say that that's better than just having accelerating revenues. Improving fundamentals, especially stocks that you saw do this, and then they've just slowly started to do this, like Garmin. Garmin is a good example of a stock that's just recently starting to do that. Well, Are they showing improving fundamentals quarter over quarter? That's a nice place where if momentum decides, or the momentum trade decides to go away, there'd still be enough of a good story there to support it. Dividend growth, and that's the one we saw with ABR. We also saw a little bit of that with Garmin. There's some dividend growth in Garmin. So these are things that you'd want to look at that would support the story of momentum. But what you don't want to do is just look at that list and say, and look at some charts and say, this looks good, that looks good, this looks good, I'm going to buy these, without understanding why. You need to understand why. The big reason you want to understand why is because in understanding why, you understand when it's over. You understand what you're looking for, what signs you're looking for that tell you it's over and to get out, as opposed to waiting for the chart or waiting for the 52-week low list to tell you that that 52-week high stock is now a short candidate. So what I tend to stay away from are the glamour momentum stocks. The stocks like Netflix, Amazon, Facebook, Tesla, that everyone talks about and they just keep going up. But their valuations, you just look at that and you're just not going to sleep well at night. Well, they're the glamour momentum stocks. I'm not a big fan of those. The ones that I look for are ones that are under momentum, but are fundamentally momentum driven. And maybe the momentum and the pricing and the valuation is a little ahead of the fundamentals at that point in time, but that if there was a retreat, the fundamentals are there to catch it. So there we go. Try some paper trades. This is my recommendation. Rather than just jumping right into this, see if you can identify 5 good winners and 5 good losers, and pick a time where you say, okay, well, I'm going to take the closing price as of this date as my entry point, because that's a typical entry point for funds, is to do a market on close order. Do a market on close order on paper. Say whatever the closing price is, I'll just say that I did a market on close order and that's the price that I got. And then just watch it over a couple of weeks and see what happens. Okay, have fun.